Imagine watching $10 million just evaporate in real time.
Oh, wow. Yeah, just gone.
Right. Just a single piece of machinery on this massive global manufacturing floor goes completely quiet.
And it's not some huge fiery explosion, right?
Exactly. No explosion. It is just a silent mechanical fault. But the cascade effect from that, it instantly paralyzes the entire assembly line.
Right, because everything is so interconnected now.
Supply chain logistics back up, perishable materials are ruined, and, delivery contracts are suddenly breached.
And the crazy part is the enterprise software, the stuff that was explicitly purchased to detect these anomalies, it fails to sound the alarm.
Yes. But not because the code was broken or anything.
No, it fails because the specific floor manager on duty that night, they didn't have a registered paid user seat to access the dashboard.
Right. So the alert just fired into an absolute void.
Which is just an absurd, entirely preventable reality of modern enterprise software architecture.
It really is. And it is the exact crisis that the company we are analyzing today is trying to solve. So, welcome to Talk Tickers, your professional earnings call summarization deep dive.
Glad to be here for this one.
Our mission today for you, the listener, is to distill the really critical underlying signals from what has to be one of the most highly contested, structurally fascinating earnings prints of the quarter.
Yeah, we're targeting PagerDuty's fourth quarter and full year fiscal 2026 results.
And the tension in this specific data set is just remarkable.
It really is, because we are essentially forced to hold two completely contradictory financial realities in our heads at the exact same time.
Right. I mean, you look at the historical data they just printed, and you see a company that is executing flawlessly on its bottom line.
Absolutely flawlessly. They just delivered their first completely GAAP profitable year.
Which is huge. They are generating massive free cash flow now.
Yeah, they basically achieved the ultimate maturation milestone for a cloud software company.
But, and this is a massive but, the moment you shift your gaze from the trailing 12 months to the forward guidance, the whole narrative just shatters.
Oh, completely. The market reaction to this print wasn't a celebration of profitability at all.
No, it was a violent repricing based on a total stagnation of top-line growth.
We are talking about a 10.5% drop in after-hours trading.
Yeah, the stock fell roughly 80 to 85 cents from its pre-release close, which was sitting near $8.
And to understand why Wall Street is actively punishing a newly profitable company, you really have to look past the headline numbers.
You have to dissect the actual mechanics of the earnings report.
Yep.
So let me just give you the rapid-fire snapshot to set our baseline here.
Go for it.
So for Q4, their GAAP earnings per share came in at 12 cents, and non-GAAP EPS was 29 cents.
Which cleanly beat the street consensus of 24 cents, by the way.
Right, a solid beat. Top-line revenue for the quarter hit $124.8 million. That is up 2.7% year over year.
And that actually beats the top end of their own expectations, too.
Exactly. They were expecting around 123 to 123.2 million. So they are beating on the top and they're beating on the bottom.
But the operational efficiency gains that are buried in those figures, they are just staggering to me.
Yeah, let's talk about that margin expansion.
So over the course of the fiscal year, they delivered a roughly 700 basis point expansion in their non-GAAP operating margin.
Wait, 700? For anyone listening who is modeling out enterprise software, a 7 full percentage point margin expansion is wild.
It's not just trimming the fat. That requires a fundamental re-engineering of how a business operates.
Like what specifically?
Well, it means automating internal processes, ruthlessly optimizing cloud hosting costs, and restructuring the go-to-market motion.
So that every single dollar of revenue requires significantly less human capital to actually secure and maintain?
Precisely. And if you look at their Q4 non-GAAP operating income, it was $29.8 million.
Which represents a 23.9% operating margin.
Right. But the gross margin metric is what really jumps off the page for me.
Oh, yeah. They targeted 84 to 86%, right?
Yeah, and they actually hit 87% in the quarter.
Okay, let's unpack that for a second. For anyone listening who isn't deep into software accounting, an 87% gross margin means that for every single dollar, a customer pays them.
It only costs the company 13 cents to physically deliver the software.
Right. That's paying for the AWS servers, the data storage, the immediate customer support.
Exactly. And the remaining 87 cents is just pure gross profit available to fund research, development, and sales.
It is basically the definition of a hyperscalable business model.
And you see it cascade directly into their cash flow. They printed $25.4 million in operating cash flow.
And $22.6 million in free cash flow for the quarter alone.
Which brings us to this really fascinating accounting anomaly that heavily distorted their full-year GAAP net income.
Yeah, the net income number looked massive, right? $174 million.
Right, but that figure was bolstered by a massive $169 million one-time income tax benefit.
From the release of a valuation allowance, yeah. This is a crucial concept to break down for you guys listening.
It really is. So when a tech company operates at a loss for years, which most do while they are scaling, they accumulate net operating losses.
Right, NOLs.
Yeah, NOLs. The tax code basically allows you to use those historical losses to offset future taxable income.
But there's a catch with the accounting rules, right?
It's a huge catch. Conservative accounting rules dictate that you cannot actually put those valuable tax assets on your balance sheet unless it is, quote unquote, more likely than not that you will generate enough future profit to actually use them.
So until you meet that profitability threshold, you have to offset the asset with this valuation allowance.
Exactly. You are effectively hiding its value from the balance sheet.
So when the auditor finally releases that valuation allowance,
it is basically the accounting world officially stamping the company as structurally permanently profitable.
That's a huge signal. The auditors have looked at the 700 basis point margin expansion, the 87% gross margins, the sustained free cash flow.
And they determined that this company is never going back to the cash incinerator days of early stage tech.
Right. It is a massive structural validation, but, and this perfectly sets up the paradox we mentioned earlier.
Oh, here comes the gut punch.
Yeah. If the financial foundation is this bulletproof, the Q1 and full year fiscal 2027 forward guidance reads like it's from a completely different company.
It really does. So they guided Q1 revenue between $118.0 million and $120.0 million.
With non-GAAP EPS of 23 to 25 cents.
And for the full year of fiscal 2027, the forecast is revenue of $488.5 million to $496.5 million.
Which misses the street consensus of $506.9 million by a mile.
Yeah, the disconnect is just jarring. The EPS outlook of $1.23 to $1.28 for the full year is solid, actually.
Right. They are targeting a 24 to 25% operating margin for fiscal 27 and steadily marching toward a long-term goal of 30%.
So they are managing costs beautifully. But that $488.5 to $496.5 million revenue range implies essentially flat year-over-year growth.
And in the zero interest rate environment of 2021, software companies were valued almost entirely on top-line revenue growth.
Exactly. Today, the market demands profitability, sure, but it still requires some growth to justify a software valuation multiple.
The market reaction feels like dropping the clutch on a high-performance sports car while you're in fifth gear.
That's a great analogy.
Right. The engine, like the gross margin and the cash flow is incredibly powerful, but the transmission just shattered because there is zero forward momentum.
Yeah, Wall Street is looking at this hyper-efficient machine and realizing that if revenue growth is flat, the highly efficient engine will eventually just be running idle.
And my read on this isn't that their specific product is failing, or that competitors are stealing all their deals.
No, I don't think that's it at all.
My read is that they're running head-on into a macroeconomic buzzsaw that is fundamentally breaking the way software has been sold for the last 15 years.
You're talking about seat compression.
Yes. They are getting absolutely crushed by seat compression.
And the data explicitly supports that read. To understand the mechanical impact here, you have to look at the deterioration of their dollar-based net retention rate, or DBNRR.
Which is really the absolute lifeblood of the software as a service model.
Exactly. It measures the percentage of recurring revenue retained from existing customers over a trailing 12-month period.
Factoring in all the upgrades, downgrades, and cancellations, right?
Yep. Historically, elite SaaS companies operate well over 110 or 120%.
And this company's DBNRR just dropped from 106% down to 98%.
Right. And if you are listening to this and wondering why Wall Street panics over a drop to 98% when total ARR is still technically up 1% year over year.
Sitting at $498.7 million, yeah.
You have to understand the compounding math of SaaS. A 98% net retention rate means your existing revenue bucket has a leak.
Right. Before your sales team even wakes up on January 1st, your business has organically shrunk by 2%.
Exactly. So you have to spend massive amounts of capital on marketing and sales, your customer acquisition cost, just to fill that 2% hole.
Just to get back to zero before you can even begin to grow.
Yeah. A sub 100% DBNRR destroys the inherent leverage of the recurring revenue model.
And the root cause of that 98% figure is really the structural flaw of the per-seat pricing model colliding with this macroeconomic downturn.
Right. For over a decade, the standard SaaS playbook, pioneered by companies like Salesforce, was to charge a licensing fee per human user.
Which made perfect sense when technology companies were hiring thousands of engineers and middle managers every single month.
Growth was just automatic. As your customer hired more people, your revenue increased without you having to sell them a single new product.
But when interest rates rose and venture capital dried up, the tech sector executed mass layoffs.
And the moment a customer fires 100 engineers, they immediately call their software vendors and demand to downgrade their contract by 100 seats.
The customer hasn't stopped using the platform. They haven't churned to a competitor.
No, the software is just as critical to their daily operations as it was yesterday.
But because the pricing mechanism is tied directly to human headcount, the vendor's revenue mechanically contracts alongside the broader labor market.
That is seat compression in a nutshell.
And what is truly fascinating here is looking at exactly where this compression is happening in their customer base.
Right, because it paints a picture of a hollowed-out middle class in the enterprise sector.
Yeah, the divergence in their customer cohorts is stark. The cohort of customers spending over $100,000 in annual recurring revenue only grew by 1%.
Meaning they basically flatlined, totaling 861 customers.
That segment is essentially paralyzed. But if you look at the absolute top tier, the customers spending over $1 million in ARR, that group grew by 10%.
Reaching 79 massive enterprise clients.
Right. So looking at this divergence, my thesis is that the mid-market is in a state of sheer survival.
I agree. The companies that barely scrape into that 100K tier are the ones most exposed to these macroeconomic shocks.
They are price sensitive, they are actively shedding headcount, and they are relentlessly auditing their software stacks to consolidate tools.
So that 1% growth in that tier suggests they are bleeding out at the bottom just as fast as their sales team can replace them at the top.
Exactly. But the Fortune 100, the true global giants, they're entirely insulated.
They aren't just retaining, they're actively expanding.
Yeah. In fact, that cohort of customers spending over 100K now makes up a massive 72% of total ARR.
So the company is essentially transforming from a ubiquitous tool for every startup into a bespoke, mission-critical infrastructure layer for the largest corporations on Earth.
And that transformation is exactly why management is executing a drastic pivot away from that legacy per-seat pricing model we just talked about.
They have to. If your largest customers are hungry for more value, but your pricing model inherently limits their adoption, you have to change the rules of the game.
This is their strategic shift toward flexible consumption pricing, or what they're calling their operations cloud model.
Right. They are actively trying to transition customers from paying per human login to paying based on the overall volume of automated actions, alerts, and workflows the platform processes.
And the mechanics of how consumption pricing solves the retention problem are brilliant, honestly.
Yeah, because it directly attacks the psychology of enterprise procurement.
Exactly. Under a per-seat model, every single time a department head wants to give a new employee access to a tool, they have to submit a purchase order.
They have to wait for procurement to approve the budget, negotiate a new license.
It introduces constant agonizing friction. It trains the customer to view your software as an expensive, scarce resource that must be rationed.
But by removing the per-seat constraint, you eliminate that procurement friction entirely.
A consumption model operates like a utility grid, right?
Exactly. You don't call the electric company every single time you plug in a new lamp. You just pay for the overall wattage you draw at the end of the month.
So when software is priced this way, the customer is actively incentivized to deploy the platform across entirely new, adjacent use cases.
Without penalizing themselves with immediate upfront licensing costs.
Right. They can expand the software into supply chain management, customer service operations, or physical manufacturing floors.
Which brings us directly back to that $10 million manufacturing failure we opened the deep dive with.
Yes. The real-world evidence that this flex pricing strategy is actively unlocking massive enterprise budgets is sitting right in the Q4 earnings data.
They highlighted a global toy maker that recently suffered a catastrophic $10 million loss in revenue.
And associated costs, yeah. Simply because a physical manufacturing process failed and the incident response was just too slow or siloed to catch it in time.
And the sheer scale of that loss fundamentally changes the buying conversation.
Absolutely.
Hmm.
When an executive at that toy company looks at a $10 million crater in their balance sheet, they are no longer interested in haggling over whether an IT manager needs a $40 monthly software
Oh, no,
license.
they're looking for enterprise-wide resilience.
And the result was that the toy maker signed a $4.5 million multi-year renewal, explicitly leveraging the new flex pricing model.
Because they weren't constrained by seats, they took a tool that was historically used only by software developers to monitor cloud servers.
And they deployed it across their physical manufacturing operations.
They weaponized the software to protect their physical supply chain.
And we saw the exact same dynamic play out with a leading North American telecommunications provider, too.
Right, they signed a $2.7 million expansion, which more than doubled their ARR with the platform.
Specifically to drive cost efficiency across their vast physical network operations, not just their IT help desk.
However, we do have to critically analyze the timing and the optics of this transition.
True. A skeptic looking at this aggressive push toward consumption pricing might argue that management is simply changing the yardstick because they know they are losing the game.
Right. If the macroeconomic reality is that technology companies are no longer hiring engineers at a breakneck pace, the total addressable market for seats has permanently shrunk.
So the flex pricing pivot could be viewed as a defensive maneuver, designed to obscure the fact that their historical growth engine has stalled out.
And I completely agree that there is a defensive element to this. It stops the immediate bleeding from headcount reductions.
But if we dig into the underlying technology they are currently shipping, it becomes clear that flex pricing is actually a Trojan horse.
How so?
Well, they aren't just trying to mask a lack of human users, they're actively preparing for a future where the primary users of their software aren't human at all.
Oh, right. The AI pivot.
Exactly. The entire flex pricing model is a prerequisite for their massive strategic pivot toward artificial intelligence.
Because if your new product roadmap relies on deploying thousands of autonomous AI agents to fix broken code, you obviously can't charge a per-seat license for a robot.
You literally can't. Which brings us to the core of the strategic bull case here. The transition from being an IT alerting tool to becoming the overarching control plane for AI.
And this narrative shift is easily the most consequential element of the earnings print.
Historically, the brand identity of this platform was essentially the digital pager.
Right. When a database crashed at 3:00 a.m., the software's job was to wake up a human engineer to go fix it.
But that identity is fundamentally obsolete in an AI-driven enterprise.
So they are repositioning the entire platform as an essential AI risk layer.
And to understand why that matters, we need to examine the mechanical differences between how traditional software fails versus how artificial intelligence fails.
The physics of the failures are entirely different.
Give us an example of that.
Okay, so if you write a traditional piece of code to execute a financial transaction and you miss a semicolon or a server runs out of memory, the system breaks in a very binary way.
Right, it throws a 404 error, the application crashes, and the transaction simply doesn't process.
Exactly. It is highly predictable, and the quote-unquote blast radius is usually contained to a temporary loss of service.
But large language models and agentic AI systems operate probabilistically.
They don't just crash, they degrade. They hallucinate wildly incorrect data while confidently presenting it as absolute fact.
Or they get trapped in infinite logic loops, consuming exponential amounts of computing power.
Which leads to massive silent spikes in GPU utilization costs.
And that non-binary nature of AI failure makes it exponentially more dangerous to an enterprise.
Oh, absolutely. Think about it. If a customer-facing AI chatbot starts hallucinating racist remarks,
Or if an internal AI agent responsible for autonomous supply chain reordering starts hallucinating demand spikes,
and orders $50 million of excess inventory.
the financial and reputational damage is catastrophic before a human ever even realizes the system is broken.
And that high blast radius is exactly why corporate boards and regulators are aggressively demanding responsible, resilient AI.
An enterprise simply cannot safely deploy autonomous AI agents into production unless they have a dedicated overarching orchestration layer constantly monitoring those agents.
Detecting anomalous behavior and automatically severing their access or reverting them to a safe state when they inevitably hallucinate.
That is the AI risk layer. They are building the emergency brake for the AI revolution.
And looking at their spring 2026 platform release, they are embedding themselves into the very foundation of the AI ecosystem to remove this.
Yeah, on the day of the earnings call, they announced over 30 new AI partners across 11 different categories.
Specifically highlighting deep integrations with Anthropic's Claude, the AI coding environment Cursor, and the agent orchestration framework LangChain.
And the inclusion of those specific partners is a deliberate signal to enterprise architects, right?
Definitely. Anthropic's Claude is currently one of the most capable enterprise-focused frontier models available right now.
And Cursor is rapidly becoming the default environment where the next generation of software is being written.
But the integration mechanism itself is what provides the real structural value here.
So you're talking about the Model Context Protocol, or MCP?
Yes. By utilizing standardized architectures like MCP, they are solving a massive security bottleneck.
Explain MCP for the listeners.
So MCP is an open standard that allows AI models to securely access external data sources without exposing the underlying systems to the model itself.
It creates a secure boundary.
Exactly.
Because if I am an enterprise chief information security officer, I am terrified of letting an AI agent look directly at my proprietary database or my live production servers.
You'd be crazy to allow that. So the Model Context Protocol acts as a secure airlock.
The AI agent can request context about why a server is failing, and the protocol securely retrieves only the necessary logs.
Strips out sensitive customer data and hands it back to the AI.
By embedding MCP into their platform, PagerDuty is essentially offering themselves as the secure, trusted middleman between the raw compute power of Anthropic and the sensitive internal nervous system of the enterprise.
Which leads directly to the deployment of their flagship SRE agent, the Site Reliability Engineering Agent.
And this isn't just a chatbot that summarizes log files, right?
No, they are framing this as a virtual responder capable of autonomous remediation.
It is currently acting in a consultative role for hundreds of clients, with early access expanding in Q2 of 2026.
And fully autonomous remediation is targeted for the second half of the year.
So the agent detects a complex failure, diagnoses the root cause, and actively executes the code required to fix it,
dramatically reducing the mean time to resolution.
But here is the massive, glaring question that every investor listening to this has to be asking.
What is the actual defensible moat here?
Exactly. If the foundational intelligence is being provided by Anthropic or OpenAI, and the orchestration is being handled by LangChain.
What stops Microsoft or Google or some highly funded Y Combinator startup from just stringing those exact same open source components together?
Right, and building a competing SRE agent over the weekend? Why does an enterprise need to pay a premium for this specific company's agent?
That is the million-dollar question regarding the commoditization of AI wrappers. And the answer lies entirely in proprietary historical data.
Because a generic AI model trained on the public internet knows how to write Python GERD.
And it generally understands how a Linux server operates, sure.
But it has absolutely no context regarding the specific idiosyncratic architecture of a Fortune 500 company's proprietary database.
The one that was custom built in 2014 and patched together with duct tape over the last decade?
Well, it lacks institutional memory.
Precisely. This company, however, has been the central nervous system for enterprise incident response for over a decade.
They processed billions of events last year alone.
They managed nearly 1 billion actual incidents and executed millions of automated workflows.
So that vast repository of historical incident data acts as a shared agent memory.
Yes. When their SRE agent encounters a novel failure, it isn't guessing based on public internet data.
It is referencing exactly how similar anomalies across thousands of identical enterprise environments were successfully resolved over the last 10 years.
And that proprietary context grounds the AI. It drastically reduces hallucinations.
And it provides a level of deterministic reliability that a generic model simply cannot replicate.
It's the difference between a medical student who just read a textbook and a seasoned trauma surgeon who has seen the exact same gunshot wound 500 times.
You want the trauma surgeon operating on your database.
Every single time.
And we have concrete proof that the largest companies on Earth are willing to pay for this specific expertise. Let's examine that landmark semiconductor deal they highlighted.
Oh, this was a massive signal.
They closed a $1 million expansion with a global semiconductor supplier on top of a multi-million-dollar base contract.
And the critical detail here is that more than half of that $1 million expansion was attributed explicitly to the platform's new agentic AI capabilities.
The significance of that deal really cannot be overstated. A global semiconductor supplier, the exact type of company manufacturing the GPUs that physically power the AI revolution.
Is utilizing this platform to manage their own infrastructure.
But more importantly, they are using the AI SRE agent to actively streamline their physical supply chain and optimize their own GPU utilization.
They're literally using AI to make sure the machines building the AI are running at peak efficiency.
It proves definitively that the technology can be monetized far beyond simple IT alerting. It is penetrating core operational orchestration.
But, and this is a huge but, if you're listening to this and trying to reconcile that semiconductor deal with the financial guidance we discussed earlier,
The cognitive dissonance is absolutely deafening.
if these AI agents are so incredibly valuable, if they're securing million-dollar expansions from the most sophisticated tech hardware companies on the planet,
Why is the overall top-line revenue guidance for fiscal 2027 completely flat?
right, are customers refusing to pay a premium for AI?
Or is it becoming table stakes, where enterprise buyers expect these features to be bundled into their existing contracts for free just to secure a renewal?
I think the flat revenue guidance suggests that while the AI narrative is securing high-profile wins at the very top of the enterprise pyramid,
It is not yet broad-based enough to offset the severe seat compression happening in the mid-market.
exactly. The sales cycles for these complex transformational AI implementations are incredibly long.
You are no longer selling a simple developer tool. You are asking a chief information officer to fundamentally alter how their organization manages risk.
That requires extensive proof of concept trials, security audits, and board-level approvals.
So the AI revenue is a slow burn structural transition, whereas the mid-market churn is an immediate mechanical bleed.
Which means the company is staring down a grueling transition period.
They have to fund this massive AI research and development build-out and convince the broader market to adopt consumption pricing.
All while weathering a period of zero top-line growth,
To survive that valley, they have to be ruthlessly disciplined with their capital allocation.
which transitions us perfectly into the broader investor context.
Right, looking at how management is physically deploying their cash, restructuring their go-to-market teams, and battling the macroeconomic headwinds currently crushing the entire software sector.
Let's start with the cash generation and the buyback program, because management is sending a very aggressive signal to the market here.
Oh, highly aggressive. In Q4 alone, the company repurchased 8 million shares of their own stock for roughly $99 million.
They have exhausted the vast majority of their $200 million share repurchase authorization, leaving only about $63 million available at the end of the quarter.
Yet, they still have approximately $470 million in cash, cash equivalents, and short-term investments sitting on the balance sheet.
The mechanics of a corporate buyback at this scale are fascinating.
When management drops nearly $100 million in a single quarter to buy back their own stock while the price is sitting in the single digits,
They are essentially weaponizing their balance sheet against the public markets.
they are looking at the 700 basis point margin expansion, looking at the AI product roadmap, and determining that Wall Street is fundamentally mispricing the asset.
By buying back the stock, they are retiring those shares, reducing the overall share count, and mechanically increasing the earnings per share for the remaining investors.
Beyond the financial engineering, it establishes a structural floor for the equity.
Institutional investors look at that $470 million cash pile and realize that if the stock price drops too far on macro panic,
Management has the dry powder to step in and sweep the market, buying up cheap shares and stabilizing the price.
the downside risk is heavily mitigated by the sheer volume of cash they are generating.
However, their own internal modeling cautions that the cash machine won't be quite as perfectly frictionless next year.
Right. They guided that free cash flow margins for fiscal 27 are expected to be 2 to 4% lower year over year.
Primarily driven by lower interest income on their cash pile as rates potentially drop, higher capital expenditures for facilities, and timing variations in payments.
And a slight dip in cash flow efficiency places even more pressure on the newly restructured executive team to execute the turnaround.
Because we have significant leadership turnover and go-to-market shifts happening simultaneously.
They brought in a new chief revenue officer, Todd, to re-engineer the enterprise sales motion.
While their chief marketing officer, Catherine Calvert, has taken control of the product-led growth, or PLG, engine.
And looking at the top of funnel health metrics, that PLG motion is actually showing signs of life, despite the flat overall revenue.
Total free and paid companies on the platform grew by 14%, reaching over 35,000 organizations.
Total paid customers grew by a modest 2% to 15,351, but they specifically highlighted that freemium conversion rates are improving.
The health of that product-led growth funnel is critical because it represents a zero marginal cost customer acquisition channel.
Yeah, the traditional enterprise sales cycle requires flying a team of account executives to Dallas to take a CIO out for a steak dinner just to pitch a $500,000 contract.
It is incredibly expensive. But in a PLG model, a junior developer at a mid-sized logistics firm downloads the free version of the software on a Tuesday to fix a localized bug.
6 months later, as that developer's team grows, they hit the usage limits of the free tier and simply input a corporate credit card to upgrade to a paid consumption tier.
The software sells itself from the bottom up.
And as a proxy for how deeply this software embeds itself into the critical operations of those organizations, I was really struck by their focus on their nonprofit footprint.
Oh, right. They highlighted that over 650 nonprofits currently use the platform.
Specifically calling out an organization called Serum.
Serum uses the software to orchestrate the redistribution of $300 million in surplus medicine to 500,000 vulnerable patients across the country.
And my read on this isn't just a feel-good corporate social responsibility flex.
No, it is a calculated strategic narrative device aimed squarely at enterprise buyers.
The subtext is entirely about reliability under the highest possible stakes.
If an e-commerce website goes down, the company loses a few hours of shoe sales.
Right. But if Serum's logistics network fails and the alerting platform doesn't trigger a response, life-saving medicine physically degrades on a loading dock and doesn't reach a patient.
By demonstrating that organizations managing life or death physical logistics trust their infrastructure to this platform, management is providing a bulletproof proxy for reliability.
They are signaling to Fortune 500 CIOs that if the platform is robust enough to guarantee critical medicine delivery, it is undeniably robust enough to manage your proprietary AI GPU clusters.
But even the best narrative devices can't obscure the fact that they are executing this pivot during a massive structural transition in the executive suite.
The most jarring internal news has to be the departure of their chief financial officer, Howard Wilson.
After nearly a decade with the company, yeah. They're currently progressing on a search for a replacement, aiming to announce the new CFO in Q2.
A CFO departing immediately after the company achieves its first full year of GAAP profitability.
And directly in the middle of transitioning its entire pricing model from per seat to consumption.
It is a highly disruptive event. The market inherently penalizes uncertainty in the finance seat during a transition year.
They are attempting to stabilize the optics of the board and executive team by adding seasoned operators, recently appointing Scott Aronson to the board of directors and bringing on Chris Farrow as chief legal officer.
But the interim period will undoubtedly invite scrutiny.
And that scrutiny is amplified tenfold by the absolute carnage currently unfolding in the broader software market.
Let's zoom out and look at the macro backdrop because it provides the necessary context for why this specific stock has been punished so severely.
Over the last 3 months, this stock is down a staggering 44.2%.
In that exact same time frame, the S&P 500 is only down roughly 2.3%.
But the truly telling metric is the IGV, the primary ETF tracking the broader software sector, which is down 21.3%.
The entire software ecosystem is bleeding, but this company is bleeding twice as fast as its peers.
We are observing a generational rotation out of enterprise software.
During the pandemic era, zero interest rate anomaly, enterprise buyers suffered from extreme FOMO.
They bought every single observability tool, productivity suite, and alerting platform available, redundantly layering software on top of software.
Today, those same buyers are relentlessly rationalizing their stacks. They are ripping out redundant tools and demanding hard, provable return on investment for every dollar spent.
Consequently, vendors in the observability space are facing a show-me-the-money reckoning regarding AI.
Investors are completely exhausted by AI press releases. They no longer care how many cutting-edge open-source models the company integrates with.
They demand immediate proof that these AI features can re-accelerate durable top-line revenue growth.
Because this company printed flat guidance, the market concluded that the AI narrative, while technologically sound, is not yet capable of overpowering the macro headwinds of seat compression and budget rationalization.
Let's synthesize this incredibly complex landscape. We are looking at a deeply paradoxical asset.
On one side of the ledger, you have a highly profitable cash-generating machine with an 87% gross margin.
They have achieved full GAAP profitability, validated by the release of a massive tax valuation allowance.
They possess a historically sticky product that the largest Fortune 100 enterprise giants increasingly rely on to orchestrate their physical and digital operations.
And they have a technologically profound AI roadmap, leveraging a decade of proprietary incident data to build a highly defensible SRE agent that global semiconductor companies are actively paying millions to deploy.
But on the other side of the ledger, top-line growth is completely stalled out.
They're fighting a brutal war against seat compression that is aggressively hollowing out their mid-market customer base.
They are in the middle of a painful, high-friction transition to a consumption-based pricing model.
Their CFO is departing, and they are operating in a macroeconomic environment that is actively hostile to software vendors.
As a result, the stock price has been absolutely decimated, trading at a deeply compressed valuation multiple.
Which makes this the ultimate contrarian setup.
When the underlying mechanical reality of a business diverges this violently from the public market's valuation of that business,
It demands incredibly creative structural market thinking to capitalize on the inefficiency.
and exploring those structural inefficiencies is exactly what we do best.
Which brings us to our signature Talk Tickers sign-off.
Our favorite part.
If you are listening to this, I need to remind you explicitly, you are listening to an exploration of public data and market mechanics. Absolutely none of this is financial advice.
We are simply connecting the dots on how institutional capital exploits the exact type of market dislocation we just spent the last hour dissecting.
So, given the extreme divergence between their profitability and their valuation, how does sophisticated capital approach an asset like this?
What is the structural play for a zero-growth, high-margin AI software company?
I call this specific trade architecture the LBO AI strangle.
Let's unpack that.
I want you to look at this company not through the lens of a retail stock trader looking for a quick tech bounce, but through the cold, mechanical lens of a private equity buyout firm.
Okay, looking at the assets sitting in the basement at roughly 7.15 to 7.20 a share.
You have a company generating over $100 million in annual free cash flow.
You have $470 million in cash on the balance sheet.
And most importantly, you have an 87% gross margin and a management team that just proved they can expand operating margins by 700 basis points in a single year.
The profile is absolute textbook.
The massive private equity firms, the Thoma Bravos and Vista Equities of the world, specialize in leveraged buyouts, or LBOs, of enterprise software companies exactly like this.
Their standard playbook is to acquire a mature software company, take it private, ruthlessly fire the bloated sales and marketing staff,
Strip the operations down to the bare metal, and use the sheer cash flow of the sticky enterprise contracts to pay down the debt used to buy the company.
But the beauty of this specific setup is that the company has already done the agonizing work of cutting costs and expanding the margins themselves.
Exactly. They are a turnkey cash machine. The public equity markets are throwing the stock away purely because revenue growth is flat for fiscal 27.
But private equity does not care about pleasing quarterly public market growth expectations. They care about cash yields.
So the primary catalyst for this trade is the high probability of a PE firm swooping in and taking the company private.
So how do you architect the trade to capture that catalyst while hedging against the very real possibility that they simply remain a public company trading sideways for the next 2 years?
It is a three-tiered structural trade. Step 1, you buy the underlying equity at this deeply compressed $7 range.
Your downside risk is mechanically buffered by the reality that the company is actively utilizing its massive cash pile to buy back its own shares.
Right, the balance sheet is providing a structural floor. Step 2, because the entire public market currently believes the stock is dead money due to the flat fiscal 27 guidance, implied volatility is crushed.
But you can still generate yield by selling near-term, out-of-the-money call options against your stock position.
You are essentially getting paid a premium by speculators who are making low probability bets on short-term bounces.
You are harvesting yield from the market's boredom.
Precisely. You use the premium collected from selling those short-term calls to finance step 3. You buy long-dated LA options.
Bellies, long-term equity anticipation securities. They are simply call options with expiration dates pushed out 1, 2, or even 3 years into the future.
Like late fiscal 2028. They give you massive leveraged exposure to the upside of the stock price for a fraction of the cost of buying the shares outright.
By using the short-term premium to buy the LAPEs, you are essentially funding your long-term leverage for free.
Let's run the scenario analysis on the LBO AI strangle. How does it resolve?
You have two highly asymmetric winning scenarios. Scenario A, the private equity thesis plays out.
Thoma Bravo looks at the 87% gross margins, announces a leveraged buyout next month, and pays a standard 30 to 40% acquisition premium over the current share price.
Your underlying stock position immediately pops, you cash out, and you walk away with a massive risk-adjusted return.
And scenario B, the longer-term structural play. What happens if management successfully fends off the PE firms and remains public through the painful fiscal 27 transition?
If they stay public, you just keep selling short-term calls, getting paid to patiently wait out the flat revenue year.
And then, as the macroeconomic environment normalizes, as the painful transition to consumption pricing finishes,
And those proprietary AI-driven SRE agents finally trigger hyper-growth expansions within the Fortune 100 enterprise cohort.
the stock violently re-rates upward. When the market realizes the AI control plane narrative was real all along, your long-dated LAP options capture that explosive upside, providing massive leverage returns.
The LBO AI strangle protects your downside with cash, pays you to wait out the stagnation, and levers you for the eventual realization of their AI product roadmap.
It is a masterful dissection of market mechanics. It capitalizes entirely on the duration mismatch between Wall Street's demand for immediate quarterly growth and the multi-year structural reality of transitioning an enterprise software pricing model.
And that profound duration mismatch brings us to the end of our deep dive.
But before you take your earbuds out, I want to leave you with a final provocative thought to mull over as you watch the AI revolution fundamentally rewire the enterprise economy.
We spend a massive amount of time today dissecting the mechanics of the AI risk layer, the concept of deploying autonomous SRE agents to monitor, debug, and fix the hallucinations and failures of other AI models.
The concept of AI policing AI.
Right. So I want you to think about the long-term downstream consequences of that architecture.
If an overarching AI system becomes truly capable of autonomously diagnosing a database failure, writing the patch, and executing the fix without human intervention.
And the software that manages that overarching AI is priced purely on consumption rather than per human seat.
What happens to the labor market? Do we eventually reach a point where the enterprise needs drastically fewer human software engineers to maintain their infrastructure?
Or do they just need an infinitely more expensive, mission-critical PagerDuty subscription to manage the robots doing the engineering?
It is the ultimate paradox of automation. The industry might successfully automate away the human engineer, but in doing so, the software that monitors the automation becomes the single most valuable point of failure in the global economy.
We would love to hear your thoughts on this paradox. What is your read on the current enterprise software macroeconomic environment?
Are buyers being rationally cautious, or are they underestimating the structural shift AI is about to force upon them? Reach out, share your models, and let us know.
Keep your eyes relentlessly focused on the underlying data. Always question the prevailing market narrative.
And we will see you on the next Talk Tickers Deep Dive.